Hello, you're watching Teatime Tuesday. I'm Rashan Gidwani. We've reached the end of the year. We did witness COVID, rising inflation, and borders reopening globally. So moving forward into 2023, which stocks and sectors can give higher returns and why? Joining me to discuss this today is Paul Chu, Head of Research from Phillip Securities. Hi Paul, can you give us a recap on this year as far as major events go in Singapore?
The three things that stood out for us was firstly the Omicron virus. I think when we entered 2022, we were all worried how it would spread, not the severity, but I guess that didn't pan out. And thankfully, Singapore reopened in April. The second thing that stood out was obviously the Russian-Ukraine conflict that took commodity prices spiraling upwards. Finally, for us, I think this was probably that area where impacted the market the most was thirdly, interest rates. So when we entered 2022, expectations was amazingly that interest rates would only rise from 0 to 0.75, below 1%. Right now, I think as we exit 2022, we're probably going to hit 4.25 to 4.5. That spike really hurt the market in terms of growth expectations and especially in terms of valuations. That really took the market down in terms of valuations.
So you mentioned three events just now,
Yeah.
COVID, the Russia-Ukraine war, and rising interest rates.
Yeah.
Which sectors do you feel will be resilient or even thrive under these conditions moving forward?
Right now for us, I think domestic Singapore will do well. Let me just give you a flavor of the current situation in Singapore. So if you look at retail sales in Singapore, I think we are trending at maybe 14%. And this is huge. Retail sales in Singapore hardly grows. It's probably like 1% a year. We have record foreign direct investments. We are around 100 billion a year in foreign direct investments. In general, this reopening theme will definitely benefit Singapore and act as an additional growth driver. Because tourism is almost 5 percentage points. So for us, domestic Singapore would be a sweet spot, whereas externally, I think we are a bit more worried, but this will probably translate mainly through the electronics sector, which could not, and even commodities which could be trending lower.
Okay, so you mentioned a few sectors there, but people are still buying houses in Singapore as far as the property sector goes. And to add on to what you said earlier, interest rates have risen significantly in 2022, right? So which player in the market stood out to you?
Just to give an understanding, why property prices even rose during the pandemic, which is a bit counterintuitive. So what has happened, if you look at the demand side, demand has been very robust for property. We have very strong HDB upgraders. What is underpinning it is, of course, we have like 20,000 marriages a year. So technically, that is the underlying demand. And supporting that demand has been wages. Wages now in Singapore is up almost 7%. This is like more than a decade high. Secondly, we have very robust employment situation. The vacancy ratio is about 2.5. What we mean is that for every person that's unemployed, he or she has about 2.5 of jobs available. So that underpins the demand situation. Then at the supply side for property, what we have is that supply is very constrained. Right now, inventory to sales, that means the amount of inventory available to sell is only 1.5 years compared to a typical year of almost 3 years. So the demand supply has remained favorable for property, and we think this should continue. The one developer that will benefit from all this will be city development. In this current cycle, the developer that has the most inventory is the winner because it's just a dearth of supply. Some of the key mass market areas like your OCR, there's only less than a year, 6 months of inventory available. So I think that will underpin the robustness of the property sector.
Okay. There have been 20,000 marriages this year. So these partners, these couples, they're going to be buying houses in Singapore. Now, the finance industry earns from rising interest rates as far as when these couples buy these houses, right? Is there a clear winner that will stand out in Singapore as far as financial players go?
The local banks are the clear winners. I think one way to differentiate the banks in this rising environment, like who wins, is the bank that has the highest CASA, which what we call it is a current account savings account. So this is virtually zero cost. I mean, nobody pays us for current account and hardly get anything for savings. Just to give you an illustration of how the banks are benefiting. So banks' net interest income now has grown recently almost 40%. So they're like trading like a Nasdaq high growth stock. What happens there? Let's give you an example. Let's say you have a 100,000 loan. So when rates rise, the banks will tell the customer, hey, interest rates are up 3%, sorry, you have to pay me. But on the deposit side, what they pay customers, if you have a high CASA, let's say 90,000, the example is CASA, you don't have to pay the customer anything because current account savings doesn't get anything. So what you have to pay is maybe more on the fixed deposits. So that maybe you have to pay maybe about 2%. So you earn a huge spread, and that huge spread costs the bank nothing. They don't have to employ any additional staff. They probably just have to employ someone to make sure the reminders are sent to all of us to pay up for our housing loan. So that's why this is a very favorable environment for the banks as interest rates rise. So CASA is the key differentiator. The two banks with the most CASA will be DBS and OCBC, which we have a buy call on.
So the banks will make money off that fixed deposit, but there's been other sectors that have done well since COVID and the reopening of borders earlier this year in April, just like you said earlier. So hospitality and transportation did well. Next year, which companies can maintain these levels of growth and why?
For next year, we think let's say domestic Singapore will do well. So the hospitality, maybe the names like Genting, although we don't cover them, but these are some of the beneficiaries. Some of the hospitality REITs we like because they can immediately reprice, even though interest rates are rising, they can immediately reprice by charging higher room rates. And in Singapore in particular, I think right now the revenues of RevPAR, room rates and occupancy is 20% higher than pre-pandemic. So it's even better than a pre-pandemic. And this is even before the Chinese borders are reopened. The other area that has been growing right now has been the oil and gas sector, which we think can continue. I think if you take a proxy like Sembcorp Marine, what has happened is their order books has jumped, sevenfold because of the whole, and there are also other small cap beneficiaries. So these are some of the sectors that has done well, and that actually benefits a stock like what we cover, which is Keppel Corp. And that buoyant oil and gas environment allows them to kind of demerge their oil and gas business, and where we expect that to cause a re-rating for the Keppel Corp stock. So for us, areas of growth would be services, and we think emerging markets, especially ASEAN, can still perform well in comparison to a weaker goods sector and a weaker developed country economic conditions. I think some of the core themes that we are looking at for 2023 will be a bit more defensive. I think what we see is economic conditions kind of tapering down, and at the same time, rates will continue to be elevated. But what we like is actually REITs, I think. So we think REITs will be a sector that looks interesting for us as we enter 2023.
Okay. I think that about sums it up. Thanks for your time, Paul. We'll chat again soon. Merry Christmas. Happy New Year.
Thanks.
Paul and I had a great discussion. We discussed some of Singapore's top stocks and sectors that you can look at moving forward into 2023. Stay tuned for our next episode, which will feature more insights and analysis. I'm Rashan Gidwani, and you've been watching Teatime Tuesday. Please like and subscribe for more. See you again.